In today's video, we are going to learn about these 5 core Greeks that we see in options contracts, and we're going to finish by going over a simulator that I have put together where we can manipulate the option parameters and see those Greeks being updated in real time. Diving into the core Greeks, we can start with delta. Delta is the first order sensitivity of an options price to a $1 move in the underlying asset. In this case, this could be a stock. So for call options, delta ranges from 0 to 1, and for puts, delta ranges from -1 to 0. And so if we go over these two examples for a call option, if the underlying stock went from 100 to $101 and the delta was a zero point 0.5, our option gained 50 cents. On the flip side, if we had a put contract and the stock went from $50 to $51, we would have a negative delta. And in this case, we would have negative zero point 0.4. The option would lose 40 cents if we had a $1 move in the stock. And so you can think of delta as a rough probability of finishing in the money. So when you see things like zero point 0.5 for delta, you could imagine that you have a 50% chance for that option to expire or finish in the money. Moving on to talk about gamma. Gamma very simply tells you how fast delta itself will change when the underlying stock moves. And so gamma is always positive, right, for calls and puts. It's largest when an option is at the money and as expiration approaches. And in this example, if the delta is zero point 0.4, gamma is 0.1, if we had a $1 move in the stock, delta then becomes 0.5. So it's measuring delta acceleration. Next up, we can talk about theta. Theta is time decay, the amount your option loses day by day as expiration approaches. So for long options, theta is negative. For short options, theta is positive, and you collect that decay. So for this example, theta is negative 0.05. Your option loses 5 cents in value each calendar day. And so theta very simply tracks daily time decay. Next, we can talk about Vega. Vega measures sensitivity to implied volatility. Implied volatility is a measure of how much the market believes the price of a stock or other underlying asset will move in the future, and is a key factor in determining the price of an options contract. And so in this scenario, Vega is 0.1, so a 1 point rise in implied volatility would add 10 cents to your options contract. And so Vega peaks for at the money and long dated contracts and then decays over time. And so one more quick example, if you were to buy before earnings, hoping that implied volatility jumps up 20 points, 20 times 0.10 is $2 of added value that you would get from your contract. Finally, we can wrap up the core Greeks with rho. So rho captures the effect of interest rates on option prices. You don't hear people talk about rho quite as much, usually minor changes to your option contract, but still being aware of what it is important. And so for calls, the rho would be positive, and for puts, rho would be negative. And so for example, in this case, if rho was 0.05, and you had a 1% increase in rates, that would add 5 cents to call values, and it would subtract 5 cents from put values. Now we can look at an actual options contract example and understand what the Greeks would mean in this particular case. And so we're looking at a Robinhood contract where we would be buying a call option that expires in 8 days with a $48 strike price. And so if we're looking at the Greeks down here, we can see that the delta is 0.54. And so this would mean that we would pick up about 54 cents for every $1 move in the Robinhood stock. And so we can see that Robinhood is currently trading at $48.93. So if this were to move up, this arrow here, by $1 to $49.93, we would collect about $54 on that option, or the option would gain 54 cents. And so you can really think of delta here as your directional leverage. So a 0.54 delta you would capture 54% of the stock's move. And so that just implies, right, that there's about a 54% chance that this option finishes in the money. Now we can go back to gamma and remember that every $1 change in the underlying stock will affect the move of delta. And so in this case, if gamma is 0.04 and the stock were to move up by $1, we could take the current delta plus the current gamma, and that would become the new delta, right? And so in this case, it would be about 0.58. So delta becomes 0.58 if the stock were to move up by $1. That is what gamma is telling us here. Theta is basically telling us that we would lose almost $22 per day with this options contract. Now, this is pretty pretty steep, but that's only because the contract expires in a short period of time, right? You would typically see the theta be a little bit smaller in this case, right? If the contract expired a month from now, 3 months from now, etc. Vega, this is talking about the implied volatility, right? So every point that this moves, it's going to basically have a 2 cent move on the actual underlying contract, which is what we're looking at. So it would either go up 2 cents or down 2 cents. You can see that implied volatility is currently really high. We are very close to earnings. I believe earnings is in about 5 days. And so you can see that implied volatility is quite high. And then finally, talking about rho, it's basically zero in this particular example. And so if we had a rate cut or a rate hike, really not going to affect this particular options contract. All right, now that we've gone over a real options contract example, we can head over to the simulator that I put together. I'll leave the link to the simulator in the description down below. I'll just cover this really quickly. I think it's better for everyone watching to get their hands on themselves and play around with it to really understand the Greeks and how the parameters can affect the Greeks and vice versa. And so I'll just explain what really the simulator is. So we can go over either calls or puts, and you can see how that will affect the default Greeks. And then, you can open up this modal and see the Black-Scholes model. I'll leave a link in the description to the Black-Scholes model if you want to read more. But really, you'll be able to just look at these option Greeks, look at the parameters, and be able to play around with them and move these sliders and see how it affects the core Greeks, right? Which is really cool to see in real time, right? Expiration, for example, you can see how that is affecting the Greeks, the strike price, and everything in between. And that is going to wrap up the video talking about the core Greeks for options contracts when we are options trading. If you have any questions, feel free to put them in the comments section below, and we will see you in the next video.